For decades, Japan quietly lent the world trillions of dollars, almost for free. Now, that money is being called back home in strange, cryptic warnings from an anonymous insider, messages millions have already read, hint that Japan is prepared to bring its wealth home by any means necessary. There's even a number attached to it. Article 589. You'll hear that number again, because what happens next could decide whether your savings, your mortgage, even your retirement account. Stay safe. Somewhere in Tokyo, a quiet shift is taking place inside Japan's economy, and the effects are already reaching far beyond its borders. For years, Japan kept its interest rates at zero. That single decision shaped how money moved around the entire world. When money is free to borrow, big investors take notice. Banks, hedge funds, and large institutions realized they could borrow yen for almost nothing, convert it into dollars, and invest it anywhere that paid more than zero. This strategy became known as the yen carry trade. It funneled trillions of dollars into U.S. stocks, bonds, and other assets across the globe. Very few people realized how much of that global wealth was quietly built on borrowed Japanese money. For 3 decades, Japan lived through a strange economic reality. Prices stayed flat, wages barely moved. It was a world without inflation, and Japan's government kept rates near zero to survive it. As long as prices stayed still, the system worked. The country carried an enormous debt load, more than 200% of its entire economic output, yet it never collapsed. That was because most of that debt was owned by the Japanese themselves, not by outside investors. The Bank of Japan owned close to half of it. Local insurance companies and banks held much of the rest. Foreign investors held very little. That difference protected Japan from the kind of panic that toppled other heavily indebted nations in the past. But in 2020, the world changed. A global pandemic disrupted supply chains everywhere. Energy prices climbed. Inflation, a problem Japan had not experienced in a generation, finally arrived. By 2022, prices in Japan were rising for the first time in decades. Other major economies responded quickly, raising interest rates to control inflation. Japan hesitated. Raising rates meant risking its enormous debt load. Doing nothing meant risking its currency. Japan chose to hold its rates near zero for longer than most other nations. That decision had consequences. As other countries offered higher returns on their currencies, investors moved their money away from the yen and toward the dollar. Demand for yen weakened. Its value began falling, first slowly, then sharply, dropping to levels not seen in about 40 years. A weaker yen made everything Japan imports more expensive, especially energy, since the country has very few natural resources of its own. Rising import costs pushed inflation even higher, creating a difficult cycle that was hard to control. For the first time in 3 decades, Japanese workers began asking for higher wages, and many received them. It was the largest pay increase the country had experienced in more than 30 years. At the same time, a new government in Tokyo signaled plans to spend more money, meaning even more government bonds, adding further pressure on an already massive debt. Japan reached a difficult decision point. It could keep interest rates low to protect its debt, but risk destroying the value of its currency. Or it could raise interest rates to protect the yen, but risk shaking a bond market that had stayed calm for 30 years. There was no easy third option. To defend the yen, Japan's government spent around $73 billion buying its own currency and raised interest rates to their highest level since 1995. Despite this, the yen barely responded. It became clear that simply buying the currency was not enough. Something bigger needed to change. That is when Japan turned to a new strategy, one that did not involve spending more money to defend the yen, but instead bringing Japanese wealth back home. And that decision is where this story truly begins. To understand what Japan is doing now, it helps to look at what is actually happening inside its bond and currency markets today. As this story develops, Japan's currency is trading close to its lowest level against the dollar in roughly 4 decades. Major financial institutions have pointed to a certain exchange rate as a symbolic line Japan may try hard not to cross. As of now, the yen is trading very close to that line, and depending on when this is being watched, it may have already moved past it. At the same time, Japan's bond market is behaving in an unusual way. A few years ago, Japan's 10-year government bond paid a tiny fraction of 1% in interest. Today, that same bond pays more than 10 times as much. Its 30-year bond now sits around 4%. These numbers might look small compared to interest rates in other countries, but for a nation carrying debt worth more than double its entire economic output, even small increases translate into enormous costs. What makes this especially unusual is a pattern investors have noticed recently. On the same day, 2 things happened. Inflation numbers came in low, below the central bank's target, for the 5th month in a row. That would normally be considered good news. But on that same day, Japan's stock market fell sharply, wiping out an enormous amount of value, and bond yields rose instead of falling. Normally, when inflation is low, bond markets tend to calm down. In Japan's case, the opposite occurred. This has led many analysts to believe investors are no longer focused on inflation. Instead, they are asking a bigger question: who is going to keep buying Japan's debt going forward? Meanwhile, large global investors have been placing significant bets against the yen. Data tracking these positions shows a growing number of contracts betting the yen will continue weakening, representing billions of dollars in exposure. And that number likely does not capture the full picture, since much of global currency trading happens privately between banks and is never publicly recorded. In response, Japan's government has taken clear official steps. On July 10th, the country's finance minister publicly stated that the government pension investment fund, the largest pension fund in the world, holding close to $1.8 trillion, should begin shifting its investments away from foreign assets and back into Japanese ones. Following that announcement, the yen strengthened and Japan's bond yields dropped by the most in a month. Since then, data has shown Japanese insurance companies making their largest purchases of long-term government bonds in 3 years, reversing a long trend of selling. To fund these purchases, many institutions have been selling their holdings of U.S. Treasury bonds and converting the proceeds back into yen. Alongside these financial moves, Japan has introduced new policy changes. On July the 20th, the country passed legislation formally recognizing cryptocurrency as a financial asset, allowing Japanese banks to legally hold it. Officials have also proposed lowering taxes on crypto wealth held overseas from as high as 55% down to 20%, encouraging that money to return and be regulated inside Japan. There have also been unconfirmed reports referencing something called Article 589, a rule reportedly limiting how lenders can charge interest unless clearly agreed upon in advance. It is important to note this has not been officially confirmed by any government source, so it should be treated with appropriate caution rather than as established fact. Together, these developments show a country actively trying to bring its money home, using both financial policy and new legal tools to reshape where its wealth is held. What happens inside Japan does not stay inside Japan. For decades, this quiet, cautious economy has been deeply woven into global finance, and the consequences of its current shift are already reaching far beyond its own borders. For years, Japan stood as one of the most dependable buyers of United States government debt. It was, for a long time, the largest foreign holder of U.S. Treasury bonds anywhere in the world. That steady demand helped keep American borrowing costs lower than they might otherwise have been. Now, as Japanese institutions redirect their money back home, that steady buyer is stepping back, and in some cases, becoming a seller instead. When a major buyer steps away from any market, the seller has to work harder to attract new buyers. In this case, that means the United States may need to offer higher interest rates to convince other investors to keep purchasing its debt. This matters far beyond financial institutions. The yield on the 10-year U.S. Treasury bond directly influences everyday borrowing costs, including mortgage rates, auto loans, and credit card interest. So even someone with no direct investment in Japan or its currency could feel the ripple effects through the cost of a home loan or a monthly payment. There is historical precedent for concern here as well. Throughout the past several decades, sudden strengthening of the yen has often coincided with major moments of financial stress around the world. In 1998, the yen surged rapidly during the collapse of a major hedge fund, an event serious enough that the Federal Reserve had to help organize a financial rescue. In 2008, as the global financial crisis unfolded, the yen climbed sharply as risky. Borrowed investments were rapidly unwound. Similar patterns appeared in 2011 and 2016 following the Brexit vote, and again in 2020 during the onset of the pandemic. Even a small quarter-point interest rate increase by Japan's central bank in 2024 triggered a sudden yen rally, contributing to Japan's stock market experiencing its worst single-day drop since 1987, with effects felt in markets across the world, including the United States. In each of those cases, a stronger yen was not something Japan intended. It was simply a side effect of investors around the world rushing to pay back their yen-based loans during moments of panic. What makes the current situation notably different is that this time, a stronger yen appears to be an intentional policy goal, not an accidental market reaction. That distinction matters because it suggests a level of coordination and long-term planning rather than a sudden crisis response. Domestically, the consequences inside Japan carry weight as well. For older generations, particularly retirees relying on fixed savings, a weakening currency combined with rising prices can quietly erode the value of a lifetime of savings. That is part of why Japan's government is under pressure to act carefully, balancing the needs of savers, the stability of its bond market, and its enormous debt obligations, all at the same time. There are also broader questions being raised, including the significance of Japan reportedly moving to build its own intelligence-gathering capabilities for the first time since World War II. Whether that decision connects directly to these economic pressures remains unclear, and it would be inaccurate to draw firm conclusions from limited information. What can be said is that Japan is navigating a moment where financial policy, national security discussions, and global market stability all appear to be intersecting at once. For everyday people, especially those in the United States, the underlying lesson is this: financial systems today are deeply interconnected. A policy decision made in Tokyo can influence a mortgage rate in Ohio or a retirement account in Texas. Understanding these connections does not require alarm, but it does call for informed awareness of how global finance quietly shapes daily life. For Japan, the road ahead still holds two very different paths. One path involves continuing to raise interest rates and encouraging wealth to return home, aiming to stabilize the yen while accepting the added cost of servicing its enormous debt. The other path involves stepping back, keeping rates lower, and risking further weakness in the currency, along with rising prices for everyday citizens. So far, Japan's recent actions suggest officials are leaning toward the first path, prioritizing the strength of their currency and the confidence of their own citizens over short-term comfort. Several developments are worth watching closely in the months ahead. Analysts will be paying attention to how much of the government pension investment fund actually shifts away from foreign assets and into Japanese ones, since that fund alone controls close to $1.8 trillion. They will also be watching whether Japanese insurance companies and banks continue their recent pattern of buying Japanese government bonds instead of U.S. treasuries. If that trend continues, it could keep placing upward pressure on U.S. borrowing costs, including mortgage rates. Additionally, any further clarification around the reported Article 589 policy would be significant, since at this point it remains unconfirmed and should continue to be treated with caution rather than certainty. For viewers in the United States, there are a few reasonable steps worth considering. Staying informed about Treasury yield movements, particularly the 10-year Treasury rate, can offer early signals about where borrowing costs may be headed. Those planning major financial decisions, such as buying a home or refinancing a loan, may want to pay closer attention to interest rate trends over the coming months. It is not about reacting with fear, but about making informed, timely decisions based on a clearer understanding of what is driving these shifts. It's also worth remembering that global finance rarely operates in isolation. A policy decision made by a central bank on the other side of the world can, in time, influence something as personal as a monthly mortgage payment or the return on a retirement account. This is precisely why understanding stories like Japan's currency and debt situation matters, not because of speculation or fear, but because of how deeply connected today's financial systems truly are. So here's a question worth sitting with. If a major global economy that once quietly powered so much of the world's cheap borrowing is now pulling its money back home, what does that mean for the next chapter of global finance? Is this a temporary correction, or the beginning of a longer-term shift in how capital moves around the world? These are the kinds of questions that don't have easy answers yet, but they are worth watching closely in the months ahead. For those interested in following how this story develops, staying updated through credible financial news sources and official statements from Japan's Ministry of Finance and Central Bank will be key. Markets can shift quickly, and staying informed early often makes the biggest difference. Japan's decision to bring its wealth home is more than just a domestic policy change. It is a signal, one that reaches quietly into global markets, national debt, and even the interest rate on a family's mortgage thousands of miles away. Whether this leads to renewed stability or unexpected turbulence remains to be seen. Thank you for spending this time to understand a story that reaches far beyond one country's borders. If this video helped make sense of a complex topic, consider subscribing to Currency Matrix for more clear, fact-based breakdowns of the stories shaping the world's economy. Stay informed, stay prepared, and we'll see you in the next one.